Hello and welcome again to another financial analysis video with myself, Moeed Amin, and Ted Wayman. So today we're going to be looking at SCS Group, or essentially sofas, carpets specialist group. Now, the goal for this show is to help you build your business acumen. And we help you do that by understanding the language of business, which is finances. So we do that by analyzing the financial statements of famous, well-known companies, most of which are requests from you, the viewer. And I'll talk a bit later on around how you can make your request as well. So quick note about SCS Group so that you have some context before we dive into the finances. So essentially they provide furniture and flooring products. And they do that through their 98 stores, or what they call showrooms. And they have about 1,800 employees right now. So this company was a request from one of our viewers, and they provided us with some information, a bit of context there, and we're going to cover that context in our analysis as well. So Alexandru, thank you for your request. And here is your video. Would love to hear your thoughts from our analysis. What I'm going to talk about the share price as well, because stick around, we're going to talk a bit about that share price in more detail in context with what we've observed around the financial statement. One thing that's important to note is actually the like-for-like sales between 31st of July and the 19th of November. Now, sorry, not sales, but their like-for-like order intake was down just over 9%. So they're obviously seeing something happening in the market there. And on the 2nd of December, their CFO resigned, and they informed the public of this. So that CFO has a 12-month notice period. So he's actually going to work his 12 months notice period, and they are in the process of finding a replacement. Now, interesting information, it's part of your thesis or part at least of your research. Now, on the share price. So this company floated in 2015. If you'd invested back then, you'd be sitting on a decline of 15%. We don't often see that, so it's interesting that that happened to be the case here. If you invested 5 years ago, you'd be sitting on a decline of about 20%. And if you invested a year ago, you'd be sitting on a decline of around 27%. So there's certainly something going on there in terms of their share price. And we'll dig into that a little further later on. So over to you, Ted. What we'll do is we'll show you how to read and understand a financial statement of a company like this so that you can use that knowledge in any of their quarterly statements or any other company in this space as well.
Thank you very much, Moeed. Good to see you again, and good to see all of our viewers. Welcome back to our regular subscribers. Welcome if you are new, and if you aren't new, then please do subscribe. Hit the subscribe button now, and if you like what you hear, don't forget to click on the like and share with your friends and colleagues. We are here to educate. This is SCS. This is their annual report and accounts. You can find this on their website. It's very easy to find. Lots of information, tells you all about the business, who they are, who runs it, what their strategy is, what they've been up to, how they've been performing over the last year or so, etc., etc., etc. And you can read through this at your leisure if you so wish. So if you're, for example, selling to this company, this is a really good document so that you can kind of show that you understand the business and some of their pinch points and pain points better than the people who you are competing against, i.e. your competitors. So here we go. We're going to go all the way down to, so you'll notice we're on about page 111 of 142 in this document, and we finally get through to the statement of comprehensive income, which is the income statement. So let's have a look at this. Now, quite interesting here. The first thing we've got is there's quite an interesting distinction here going on between these two lines. Now, you don't often see this. It talks about gross sales and then revenue. And I have to admit, I kind of scratched my head and I thought, I've never seen that before. I wonder what, if you're in the insurance company, you get a similar type of thing, but this is not an insurance company. So for a kind of a company like this was a kind of a slightly bizarre one. And gross sales, so the difference between gross sales and revenue, I think it's actually just worth looking at this, because this gives a kind of an insight into their business model. So we're just going to have a quick look at note number 3. And here is note number 3. We've got all the account. Yeah, here we go. So note number 3, it's on the right hand side of your screen. So we're looking at this bit over here. We can see we've got the sale of goods. And then, so when they sell you a carpet, they sell you a warranty to kind of, so that the carpet does what it is meant to do, which is stay on the floor. And I don't know why you'd have warranty on a carpet, but anyway, they're selling warranties on carpets. Sofas, I guess maybe they sell a warranty on a sofa so that if your fat uncle comes and sits on it, they'll replace it when it breaks. And so there's your gross sales, which they are, that's their kind of their top line. And then they've got the cost of interest-free credit. So what this suggests to me is that, there's a financing, they're obviously selling sofas on finance and carpets on finance, and they're selling it to you interest-free, but they are paying the interest to the finance company. So they're not putting that through as a cost, and I think I've got that right. If I've got it wrong, and this business, or you work for this business, and you'd like to correct me, then please do leave a comment in the comment section. Obviously be polite. We're very polite to everyone on this channel, but do leave a comment if I've got it wrong. But it looks to me like this is the cost to the company of the credit that they are providing. So they pick up the interest when they lend you the money to buy their product. Don't worry, they're not doing it out of the kindness of their heart. They're making money elsewhere, as we will see. So that was quite an interesting so the first one. Anyway, so I'm going to talk about this line here as their revenue figure, because everything's kind of based off there. So revenue 331, and we're in thousands, so it's 331 million pounds, up from 305, so that's a 9% increase a year on year. The cost of what they're doing, so the cost of those sofas and carpets is about 175 million. That's a 53% margin. So if you pay 450 quid for a sofa, it costs them 225. Okay, and don't forget, they borrow the money in order to lend that money to you. So you may think, oh gosh, isn't it nicer than to give me interest-free credit? Yes, it is, but don't forget, you're paying twice what they paid for the sofa or for the carpet, for example. So that gives them a gross profit 156 million pounds. They've got distribution costs, so that's all our friends in vans driving around and delivering sofas, etc., etc. And then and by the way, distribution, that's distribution to you, the customer, not shipment in. So that distribution cost is being shipped to you, and then the admin cost, that's rent, rate, light, heat, HR, finance, facilities, technology, and all the rest of the kind of the overheads you get running a business like this, gives them an operating profit of just over 20 million pounds. It's about a 6% margin this year, a little bit down on last year, which was a 9% operating margin. Okay, so yeah, they're selling you a sofa for twice what they paid for it, but the reason they're having to do that is that they're carrying quite a lot of admin fees. So there's quite a lot of costs involved in actually running a business like this. A little bit of finance costs, suggesting maybe there's a little bit of debt. Now, you remember the comment said there's no debt. So if there's no debt, why is there finance costs? Well, maybe if there's no debt, then this will be the cost of the right of use asset. So often we'll have a photocopier. We either buy a photocopier or we buy a photocopier on hire purchase. If we buy it on hire purchase, there's an implied rate of interest in there, and that's what those finance costs are. We'll see that. We'll confirm that when we look at the balance sheet. And then we've also got a bit of tax down here, which is good to see that they're paying their tax to the HMRC, because Rishi Sunak needs every penny he can get, leaving them with a profit of about 30.5 million. That's a 4% net margin, or bottom line margin, down from 19 million in the previous year, which was a 6%. So their profit is down, their margin is down. So while top line is going up, their margin is going down. And a lot of that is down to things like, really, I think it's driven through this one here. There's a big increase in their administrative expenses. Okay, so that's kind of that's a kind of a question mark as to why that's jumping up so much. So there we go. So but they are profitable. It's not massive margin, but they are profitable. Let's go and look at their balance sheet and see the kind of the balance sheet strength, so to speak. So here we can see their non-current assets. The top is the non-current. This is the stuff they need to run the business. And as I guessed, there's the right of use assets. So right of use assets and the property, plant and equipment. So we kind of we talk about those two together, and the right of use assets is nearly 100 million, easily the significant. So rather than buying photocopiers, these guys are renting photocopiers. So all the stuff they need to run the business, tables, chairs, computers, it's all on hire purchase, and that's really good for their cash flow. It means that they don't have to come up with the cash in order to spend it on capex. They can pay for it out of cash flow effectively. Their current assets, they've got some inventories, trade receivables, and there's the cash. And you remember the comment said these guys have got a lot of cash. They have 71 million pounds. Okay, so there's a lot of cash sitting on their balance sheet. And the current liabilities, you can see the current liabilities down here. We like to compare our current liabilities with our current assets. So the 96 to the 77, 96 million of things that they've got which are either cash or going to become cash soon, and 77 million of things that they have to pay soon, and that gives us what's known as our liquidity ratio. And our liquidity ratio, I'm just checking my notes now, is 1.24, which suggests to me that they're easily liquid, they're easily able to pay their bills on time. And you can almost sort of, even just look at the amount of cash they've got and say the cash is sufficient to pay the suppliers. So, liquidity doesn't look an issue, even on an acid test, which is actually very relevant to these guys. So the acid test is exactly the same, but without inventory. So effectively, we're ignoring this. You're on a ratio of about 1. Okay, so you don't want to be much below 1 in their game, but 1 is okay. So they are not dependent on their ability to sell sofas to pay their suppliers in the term. No debt. You can see there's no debt. So there's the long-term liabilities. There's no debt, but what they do have instead of debt is effectively these lease liabilities, which is a form of debt finance when you think about it. So rather than going to the bank and borrowing a ton of money to buy tables and chairs, they're just using hire purchase and finance leases in order to buy them. So it's kind of debt by another name, and that's why they're paying interest. Although that debt will be secured on their right of use assets. So it shouldn't cost them too much. The the effective rate of debt rate of that debt should be relatively low because of the security provided. So yeah, so to say that it's debt free is not 100% right. These guys, they do have debt, they do have interest payments they have to make, but it's just a different form of debt, if that makes sense. Just looking at the working capital while we're looking at this section here, we look at the working capital requirement will be very important for them. It looks to me, this is back of an envelope calculation, so I'm prepared to be told that I'm wrong on it, but I reckon that it takes them, if you look at the inventory turnover, that's up here, it looks to me like it's taking them about 40 days to sell from the day they buy a sofa or buy a carpet to selling it. Takes them about 40 days. The trade receivables, very, very low. It's about 3 days. Well, we kind of make sense because they're not going to sell it and then say, oh, pay me later, or rather they do say pay me later. But that's financed through an external company. So effectively, if you do buy a sofa from them and then pay later, in effect, they are outsourcing the finance to another finance company, and that finance company pay SGS, or SCS, sorry. So that's going to help CS's cash flow, and then the finance company, they pick up the kind of the payments, and SCS, as we mentioned before, looks like they are paying the interest on that loan that effectively, so SCS pay the interest on a loan by another company who lend you the money to buy the sofa, if that makes sense. So 3 days, and then their accounts payable 35 days looks pretty reasonable. So it's kind of 40 days to sell a sofa and 35 days to pay their suppliers, which basically means that that there's no real working capital requirement. They're kind of their cash in is exactly or almost exactly matched with their cash out. Okay, and that's why this A quick ratio acid test of about 1 looks okay. So nothing else in the non-current liabilities, and down here we've got our current, sorry, the equity. In the equity, these guys really very much funded through retained earnings. Now this merger reserve, this is a little bit of a funny one. So this arises when you actually merge two companies together. I don't know what the history of these guys are, or when the sort of the merger, who they merged with and what happened, etc., etc. But it's kind of, I guess the point we're making here is that it's not physical investment by the shareholders. So this is very much funded through retained earnings being reinvested into the company, and they've got 50 million. Okay, so again, a pretty strong balance sheet there. So it's looking good. I mean, it's not bulletproof. I wouldn't say it's absolutely bulletproof, but there's no real cause for concern there. We are going into recession. If we're going into a recession, cost of living crisis and all that kind of stuff, then sofas and carpets are going to be the one that suffer, because I'll just carry on with my existing sofa. I'll put off those big purchases. So I think these guys, they're probably getting ready for the storm if they're not ready already. They are kind of they're hunkering down. And I agree with our commentator, who said, look, they've got quite a lot of cash. They should be able to ride it out. And depending on the length of the storm, I don't see why not. Here's their movement in equity, retained earnings. We can see that they have actually been paying dividends. There's a dividend that they paid last year, and sorry, 2 years ago, and the dividend they paid last year. My guess, and they actually did a share repurchase as well. So we kind of read those two together. My guess is, if I was this company, I would probably be going, maybe we'll just not pay any dividends for a while, just hunker down, make sure we weather out this storm, and then we'll come back and we'll be in an even stronger position because competitors will have gone bust. And that leads us on to the cash flow here. So net cash flow from operating activities, generating cash, which is good. A lot of that is because they are depreciating these right of use assets. It's a non-cash expense. And in here we've got the movement in working capital. So interestingly enough there, that there's quite a lot of cash being tied up in their working capital, either by paying down their suppliers, not collecting money from the customers, or increasing their inventory. Okay, and that's going to be reflected. A lot of that will be certainly the first two numbers will be because they are increasing their they're increasing their sales, so they're increasing their inventory as a result. And it doesn't look excessive there, and I'm sure their inventory is under control. Big, that's a one-off big decrease in other payables. You won't see that next year. I would expect they kind of, they just did a big payment to their suppliers for whatever reason. Cash flows used in investing, 4.7 million. Looks fine, just buying property, plant and equipment, etc., etc. And then the financing, there's the dividends that they're paying, there's the share buybacks that are going on that we mentioned, and they are also paying the capital leases of some of those assets. Now that's quite a big number. If you remember, capital, if you're paying 25 million on your capital leases, and just to remind us, when we go back to the balance sheet, here was the balance sheet. Your right of use assets are they've got a book value of about 100 million. Then it suggests to me that you're making significant repayments. I don't know what the life, I don't know what assets they've got and what the life of that assets is, but it looks to me like they should be paying off those on leases, and then they effectively they got those assets to use for free. And I think that's really kind of the big numbers. There's nothing really else out there which is which leaps out at me. So I think I would agree with our viewer who saying that it looks strong. It's not bulletproof, but it does look strong. So when we look at the market, these guys, they've been bouncing all over the place. I'm not sure what's going on with my timeline, so apologies about that. But you'll see that there's a market cap of 55 million. Well, the book value is 50 million, so it's trading at a very small premium. And the difference would be known as goodwill. You look at this PE ratio. P ratio of the market is about 5 times earnings. Now 5 times earnings is crazy cheap. My calculation is about 4 times earnings, which that's a yield of 20 to 25%. Even the dividend yield is very, very large. Dividend yield of about 8 to 9%. If you include the share buyback, you're up at a 12% dividend yield. So the dividend yield very, very large. And it looks to me like these guys have bounced and they're starting to kind of go back up again. Now, where do they go from here? I think it slightly depends. And don't forget, what we've been looking at, the financial analysis just tells you what's happened in the past. It doesn't tell you what's going to happen in the future. These guys are obviously entering into a very, very tough period, high inflation, cost of living crisis, a redundancy. We're going to have a recession, which will probably result in redundancies, and these guys operate in the kind of very much the nice to have part of the market rather than the need to have. You don't need a new sofa, it's nice to have. So I can't see this going like that. On the other hand, I can't see it going down like that. It's not bulletproof, but it's got pretty strong. So I reckon these guys, they're going to bounce around a little bit, and then as the market recovers, these guys should start to recover. Okay, so this to me, I wouldn't put it on my short list and say the shares are going to go down in value. It's massively overvalued. It looks very undervalued, but it's undervalued for a reason. So this would be a classic value investing play where you buy, you have a well diversified portfolio, you buy a chunk of shares in these guys, and you just sit on it and you don't worry about it, you don't listen to market noise, and you just let it, and then slowly you hope, and you obviously you don't just have SCS, you have a number of other investments as well, and you hope that the market will start to realize the value in these guys, and as we come out the other end, people go, oh right, and now I can, things are getting better, I can buy that sofa we've been saving up for, or I can get carpets in the bathroom or whatever it is I need, etc., etc. These guys will be well poised in order to deliver that. Okay, so that's kind of the theory. It doesn't always work in practice, but that is definitely the theory. Here we go. This is looking slightly more. I'll tell you what it was. I've just realised on the axis. So the reason for this, Moeed, if you're slightly interested, is that I was preparing this yesterday when I was sitting in Riyadh. Okay, so these are all Saudi Arabian. These are Arabian time zones rather than UK time zones. So apologies for that. I have no idea. I don't understand the whatever calendar they're using. Anyway, so the point is, you can see there's been a kind of steady decline over the last, over the last year. You can see this is for a year. There it is. So it's been a steady decline over a year, and I'm not saying that it can't continue lower. Okay, so if you're trading it, you want volatility if you're trading it, but if you're an investor, that's a screaming buy. That just says this stock is cheap, and if you think it's undervalued, then this is a good investment. So just before we finish, Moeed, just let's go back to looking at the accounts. This is our kind of our new little look. I quite like to have a look at page 88. In 88, we'll see the remuneration of the board. So we get the remuneration of the board. Here it is, and we can see Steve Carson, who is the CEO, and he is paid about 710. Now, you'll notice down here it says that he joined in January 2021, and these numbers are for the year 2022. So he's on about 700,000. Chris Muir, you'll notice, he's taken a bit of a pay cut here. So these guys are taking a little bit of a hit. Steve Carson's obviously, he's seen his pay go up, and Chris Muir has seen his pay go down. But I think this is quite interesting that he's on 710, and I think that if you want to look at how does that compare with our employees, we can find out the average wage for this company by looking at page 121. So if we look at 121, And this is, this is standard information which you will find in pretty much any annual report and account, especially of a listed company. We've got the staff costs here. So it gives us the total staff cost, which is £65 million. Don't forget, this includes those directors that we were just looking at, but they're not going to distort it massively. £65 million, 1,800 employees. Okay, so the average wage is £36,000. So if you work for SCS, you can kind of work out whether you're above average or below average there, and that means that the CEO is paid 20 times the average employee. Now 20 times sounds quite a lot, but actually in the scheme of things, in a listed company, I reckon that that's pretty low. We've seen CEOs who are paid 300 times the average salary, which I think is getting into sort of stupid, rather sort of taking the mickey territory. So 20 times average salary does not appear unreasonable, and I think that that kind of is maybe reflected in the in the culture of the organization. So I'm looking pretty good, Moeed. There's my analysis for you. I hope you found that useful and interesting. Is it a buy? You know what, Moeed, as a result of this analysis, I'm quite tempted to take a not sizable chunk of my portfolio and just tuck some into SCS to see if it will come back after the current recession, which we are either in or about to go into.
Yeah, so there you have it. If that was the analysis on SCS Group, hope you found that useful. If you'd like this video, don't forget to hit that like button. If you have people in your network that you think would actually find value from this video and they're interested in this company, don't forget to share this video. And also don't forget to subscribe and hit that notification button, because if you make a request to us for a company, then you will get instant notification when we publish it. Now, I promise to show you or tell you how you can actually make that request, and here it is. So all you have to do is, in any one of our videos, leave a note in the comment section. Of course, mention the company you're interested in and tell us why you're interested in them, whether you're selling to them, whether you're thinking about investing in them, or if you're thinking about joining them and you're up for an interview. Do leave a note in the comment section, because then we can add that context into our analysis to help you. So until the next video, thank you, everyone. Thank you, Ted.
Thanks a lot, Moeed. Good to see you. Catch you later. So I hope you enjoyed that video and found it useful and informative. Now, if you want to know more about what I do, then you can visit Talk Financials and find out about the training workshops and the clients that I work with. And the QR code is on your screen right now. If you are interested in being able to do this yourself, to do some financial analysis, there's a couple of resources. There is an online workshop. It's available on my website, or you can click on the QR code and it'll take you straight through to this online workshop where you can learn to read and understand and interpret financial information yourself. Alternatively, there is a book available at all good bookstops, particularly a very big online one, and the QR code once again will take you through to the opportunity to buy the book, and there is also a Kindle edition. Otherwise, that's everything from me. Please don't forget to like, share and subscribe to the channel. More subscribers means that you're going to get notification about new videos coming up, and also the opportunity to ask questions, and do recommend any videos any companies that you'd like me to analyze for you. I think we've got a couple of suggested next videos coming up, so please do take the opportunity, have a look at the other videos, and don't forget to like, share and subscribe to the channel, and I will see you on the next video.